Your bank account doesn't have a switch you control. Most people believe access to their money is automatic. But inside the banking system, access depends on mechanisms that operate independently of the account holder. Because the system that holds your money is not designed for unconditional access. It is designed to decide when access is allowed. And once you understand how that decision is actually made, the idea of being in control of your money begins to change. It is about a structural mechanism embedded inside modern financial infrastructure. A mechanism that determines how money moves, when it moves, and under what conditions it can be interrupted. It has existed for years. But most people only notice it when it affects them directly. The misunderstanding begins with the idea of ownership. People assume that money in a bank account behaves like physical cash. It exists inside a network. A network controlled by institutions that are responsible for managing risk, enforcing regulations, and maintaining system stability. That responsibility requires oversight. And oversight requires control. This is where the switch begins to exist. But as a system capability, it verifies, it analyzes, against thresholds that are constantly evolving. Most of the time, this process is invisible. The payment goes through. The transfer completes. Nothing appears unusual. But what appears seamless is actually conditional. The system approved the transaction. At that moment, under those conditions, this approval process is not optional. It is required. Banks operate within a framework that demands continuous monitoring of financial activity. They must detect fraud. They must prevent money laundering. They must identify patterns that could indicate risk. To do this, they rely on automated systems. Systems that operate continuously. Systems that do not rely on human awareness. Systems that make decisions based on data. These systems form the foundation of modern banking. And they are where the switch exists. Because a system that can approve a transaction can also deny it. A system that can allow access can also restrict it, not randomly, not arbitrarily, but according to rules that are built into the infrastructure. Rules that are not always visible to the person using the account. The account holder sees a balance. The system sees a set of conditions. The account holder sees ownership. The system sees activity that must be evaluated. These two perspectives coexist, but they are not the same. And the difference becomes visible only when the system intervenes. A transaction is declined. A transfer is delayed. An account is flagged for review. But from the system's perspective, they are normal operations. The system is doing exactly what it was designed to do: evaluate, decide, act. This is the switch, not a button, not a manual control, but a continuous decision-making process embedded into the system itself. And it is always active. The system is still evaluating every movement of money, quietly, consistently, without requiring awareness from the account holder. This mechanism did not appear suddenly. It developed over time, as financial systems became more complex, as regulations expanded, as digital infrastructure replaced physical processes. New ways to intervene. Individually, these changes improved the system. They made it more secure, more efficient, more capable of managing risk. But collectively, they changed something fundamental. They shifted the balance between access and control. The account still displays a balance. The card still works most of the time. Payments still go through. But underneath, the rules have evolved. The system has become more capable of deciding, more capable of restricting, more capable of intervening when necessary. And that capability does not need to be used often to be significant. It only needs to exist. Because once it exists, it defines the boundaries of access. If you want to understand how these hidden financial mechanisms work before they affect you, consider subscribing. Because most people only recognize them after the system has already acted. It is about how money itself is structured within the system. Digital money does not exist independently. It exists as entries within institutional networks. To use it, you must interact with those networks. And those networks operate according to rules. Rules that prioritize stability. Rules that prioritize compliance. Rules that prioritize risk management over individual convenience. These priorities shape every decision the system makes. They determine when a transaction is considered normal. Over time, as these systems become more advanced, their influence grows. They analyze more data. They detect more patterns. They intervene more precisely. But also more frequently, not in obvious ways, but in subtle adjustments. A slightly longer delay. An additional verification step. A transaction that requires confirmation. Each change is small. But together, they redefine how access works. This is how the rules evolve. Not through announcements, but through implementation. The system changes first. Understanding comes later. Sometimes much later. Not because it was activated for the first time, but because it was finally noticed. To something accessed conditionally. From something guaranteed to something permitted. That shift does not require a crisis. It is already embedded in the system, already active, already shaping how money moves, quietly, continuously, without needing to be announced. Have you ever experienced a moment where a transaction was blocked or delayed in a way that didn't make sense at the time? Pinned comment suggestion. Have you ever had your bank restrict or delay access to your money without a clear reason? I'm curious how often this actually happens.